Hi, good morning, good day, welcome, bienvenue, wherever you are. It's Wednesday, 29th of August 2018. We have 5 days a week, 5 different traders. So we will speak in our webinar about trading ideas, strategies, markets, maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart, so let's have a nice start like every day. This is real-time daily trading ideas. So we will start like every day with our disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. If you're a startup, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full this disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. Everything else what you like to see also available on our web pages, for example, the key information documents, the kits. Also, you will find information on our webpage about the different categorizations of clients, retail clients and professional clients, since the European-wide regulation by the ESMA. A retail client will have a maximum leverage up to 30, and professional client, if he's an eligible client and he applies to get the status, can still trade with a maximum leverage up to 500. All details about that and how to apply for a professional client status you will find, of course, on admiralmarkets.com. Or a picture shows more than 1,000 words. If you trade DAX 30 or Euro-Dollar as a professional client, you need a margin roundabout of 24 Euro only for DAX 30 and a leverage of 500. For Euro-Dollar, it will be 200. And if you're a retail client, it will be 600 or 3,333 Euro. All details about that, like said, on admiralmarkets.com. And here's also an overview about the different leverage, about the different protection levels. Retail clients will get an unlimited protection against negative balance, unlimited. Professional clients will get it up to 50,000 British pounds about our negative balance protection policy. And here's a specific link. If you check out it, you will see all details about that. This is me. My name is Jens. My English is made in Germany. So I'm the German guy from Admiral Markets. We are a big international broker. We have over 18 country offices, but I'm not the main speaker. The main speaker is the day trader of today. This is our scheme. On Monday, it's Jay's day. On Tuesday, it's Paul's day. Usually on Wednesday, it's Giancarlo's day. Giancarlo is on holiday, so we have an substitute today. It will be Jens Klatt. On Thursday, it's Marco's day. On Friday, it's DAX day. Our leading day traders live every business day, every trading day to the same time. And of course, if you like to trade Forex and CFDs, many benefits you will get only with us. For example, DAX 30 or also Euro-Dollar, two-bill spread of just 0.8 points or pips during main trading hours without additional commission with our account Admiral Markets. Also here, check all the details out on admiralmarkets.com. There you will find also our contact details and something about our regulatory background. But now it's enough from my side. Now it's time for Jens Klatt. Good morning, good day, Jens. What's your view to the markets today?
Yeah, also, good morning from my end. 1 second, I have to show my screen. So there we go. Yeah, this is me, and I'm really happy to be here today and to take over the part from Giancarlo, give some thoughts on the markets. In the morning, I was a little skeptical, to be honest. I'm still, by the way, if there's so many chances today to formulate a trading setup. Some of you might have followed this format for quite a while, probably have seen the educational webinars on the YouTube channel from Admiral Markets, and the so-called open range setup I presented there. Usually it's an open range setup. You can see it here. There's, by the way, already one trade. It's on the EURJPY again, and I will go through all the details with this trade in a few seconds. But first of all, let's focus here on the DAX and the fact that we didn't have a setup today for the DAX, and I just want to make sure that we're on the same page here and that everyone understands why we do not have a trade here, because there's one filter I'm using in my trading on top of what I presented there. It's not only this blue line, which is the exponential moving average 50 on a 5-minute time frame, but it's also that I say I need a certain volatility or level of volatility in the markets to justify taking a trade. And in fact, this is not given today. And how do I define that? It's in fact very, very simple. I look at this open range here in the DAX. So this is the time span between 8 a.m. till 9:05 a.m. German time. The reason why it's 9:05, I mentioned this several times already, but let me just tell you again why this is the case. So in Germany, in the DAX here, we have between 8 to 9 a.m. German time, the Eurex Open, where the future DAX is traded. And at 9 a.m., the spot market comes to life and comes or joins the FDAX here. Is the so-called Xetra DAX. And now the thing is that the main volume pours into the market right at this time at 9 a.m. The fact that this is the case here results in some erratic moves on the up and on the downside. And with this in mind, I want to avoid, by giving the market another 5 minutes, that I'm stopped into a trade due to an imbalance in the order book here, and purely, thanks to a purely coincidental move or a purely erratic move on the up or on the downside, with a move which does not have the significance to really significantly break out of this trading range then. And that's why it's 9:05 German time. And so then the rule says trade the break out of the range on the upside. If we break out on the upside, plus on top of that, trade above this blue line, the exponential moving average on a 5-minute time frame, or we trade the short side, and then we are breaking out on the downside while trading below this blue line, and we take the short trade then in this case. And now another filter comes to, or today stepped in and avoided taking on a trade here based on the open range. And therefore, even though it looks quite wide, the range, what you can see is, if you look at the high here of this candle, so this is the upper red line, the high says it's 12,562, while the low is this candle here. Let me just zoom in a little, 1 sec here. So this is this candle, that one here. It's 9 a.m. German time in this case. So the low is 12,539. So the difference between 539 to 562 is 23 points. And now I say to take a trade, it's not only necessary that all those parameters are given, open range is broken on the upside, while trading above the simple or exponential moving average on the upside, or the other way around for the short setup. But it's also necessary that the width of the open range is at least 0.2% of the overall index reading. So when we say the current index reading in the DAX is 12,500 points, 0.2% from this is 25 points. And when saying that the open range is only 23 points, it's not wide enough, generally speaking, by the way, for an overall low volatility in the markets in general. And this is also one thing to consider when trading such breakout setups, even if it's, or it doesn't matter if it's an intraday setup or if it's a longer time frame, let's say 4-hour chart, daily chart, whatever. You need a certain volatility in the market to make sure that the chances are given that the market, once it breaks out, also sees some momentum and has a solid chance, a realistic chance to reach the take profit level then. And this is not given in such an environment where the open range is below those 0.2%. That's the fact, or that based on that, we are not taking a trade here in the DAX. By the way, all this is very quantitative to some extent. We can also have a look here at the hourly chart. What you can clearly spot is that the overall market conditions here currently in the hourly chart, which is directly dominating our 5-minute time frame we are trading, what you can see is that after a push higher on Monday, from here yesterday and also today, the overall market conditions are not very, very spectacular. It's very, very erratic. It's very, very volatile, consolidating on a high level. It's not really attractive to really trade. I mean, sure, that could change if we break below here this region of those lows from yesterday, around 12,520 points. And currently we're trading around 5 to 10 points above that level. So it could be that within the next 10 minutes, we get a push on the downside and a push below 12,500 points. But also this does not necessarily mean that there is a real follow through on the downside and the market taking on momentum, since overall the overall volatility in the markets is very, very yeah, very, very low currently. But nevertheless, let's go over to the EURJPY and let's have a look here at this setup and the trade. So if you followed this format for quite a while, what you found out is that I'm not necessarily only focusing on the equity markets here, but also on the currency markets, and in this case, especially on EURJPY. I will just show you in a few seconds why it's very interesting to consider this, since it's in fact a very profitable trading approach. The thing is, I can say that, but it doesn't necessarily mean that it's in fact the case. But I want to show you that it has been, not only in the past, but also in the last weeks, in fact, very, very profitable to go with this approach. But before we look at this, let's focus here on those parameters. Here too, you can see I've also drawn two lines, the blue line on the downside and here on the upside. It's the Asia breakout, I would call it. It's Asia range, which is showing the high and the low in the EURJPY. In this case, by the way, on an hourly chart, even though it's very, very small, but you can view it here. It's H1, it's an hourly chart. I look at the time span between 3 a.m. German time till 10 a.m. German time, take the high and the low here. And then I also, you can see it here, the purple moving average. It's an exponential moving average 11 in this case. And I'm using it the same way. I'm using it in the DAX, for example, on a 5-minute time frame. In this case, it's the hourly chart. I'd say if we trade above that and we break out on the upside, I take the long side. If we trade below this purple line and we break on the downside, I take the short side. And that's how I use it as a filter. Thanks to the fact that here we are talking about the hourly chart, and usually the hourly chart goes hand in hand with a higher volatility. The fact that the range is not wide enough, as it was, for example, now for the DAX, the case for today, we don't need such a filter, even though we could also give it such a filter, but the chances that we are not triggered are very, very low. So usually trades are not taken usually around times like Christmas or so, when there's really no volatility, also in the FX markets. But usually volatility is not a big issue here in the currency markets, on the hourly chart in this case. What you can see is that obviously we've already broken out of this range here on the downside, even though it was only a small spike. Let's see whether the market can really take on momentum, because now the thing comes into play here. JPY usually is a currency which is used to fund carry trades, and usually you get to see an unwinding of those carry trades in a market environment where you get to see higher volatility, or where fear kicks in and where market participants start to unwind their carry trades. That's usually then resulting in strength in the Japanese yen on a broad scale here, and in many assets, not only against the euro, but also against the dollar, against the GBP, pound sterling in this case, Aussie dollar especially, Kiwi dollar, for example. And so what we somehow need for such a short trade to play out currently, I think, is risk aversion. You can see this, by the way, in clear numbers in a few seconds, that the short side was not very profitable, not only because we've seen a clear uptrend here, but also because volatility currently is quite low in the markets. And nevertheless, the system says we trade short. If we trade below the EMA 11 in this case, we were triggered on the short side. Parameters were 129.68.5. The stop is then above the high here, it's 130.20, and the take profit has to be adapted, by the way. I'm sorry for that. We have to adapt it because it's another 6 points lower, the take profit level, so it's 84 in this case. Why it's 84? Therefore, let's go over to a document I've already prepared. So currently we are talking about this one here. So the interesting thing now, obviously, is, oh, by the way, it's not correct anymore. It's 80 in this case. 1 sec. It's another 4 pips. 80. So, okay, now it's perfect. So let's go through those red lines first. So this is the setup. EURJPY Asia breakout. Entry short is the break here lower. In this time span 3 to 10 a.m. German time. The stop is placed at the high of this range. So you can see it here that the risk is 51.5 pips in this case. And now the question is, okay, where does this number come from, 128.80? Because if you carefully watch the chart here, what you can see is that probably it has something to do with this low, which was formed here, this relative low on the hourly chart. But I can tell you, no, it's not the case. It has where it's purely coincidentally that it's currently here falling into this region. So what we do or work with is a multiplier of 1.7. So we multiply our risk by 1.7 and get 88 pips in this case, and we then subtract 88 from this entry level here on the downside to formulate our target. The question is, okay, why is this the case? So multiplying it by a number, but does it make sense? Yes, from a purely statistical standpoint, it doesn't. This definitely makes sense because it generates a very smooth equity curve, and not only that, compared in relation to other equity curves, and it's generating, that said, it's generating the positive and the most positive expected value you can expect for this setup to trade with then. And it's proven for a very, very long time span, in fact, that this has been a profitable approach to trade that way, and that's why the multiplier here is 1.7 in this case, and then we formulate the target. Now, the thing is that is probably the main question coming to your mind right now is, okay, what about the performance? Does it really work? And let's work with real numbers. I mean, that makes the most sense in this case. Let's have a look at the performance of the setup here over the last weeks then. The performance in August, we had a phenomenal hit rate of 60.7%, or 2 out of 3 trades worked out. In fact, we had a trade every day. So this said, we can say in this context that, one second, please, let me just have a look here. So we had 3, 5, yeah, it's 20 trades in this case. Yeah, it was 20 trades. And in this context, you can see here that, or it was 21 trades. I'm sorry, it was 21 trades, and it was 14 winners. It was 14 winners and 7 losers, and we had many trades on the long side. No coincidence that obviously we had a very favorable market environment since the midst of June here, August, I'm sorry, we've seen a nice upward structure playing out, and in fact, the long side added enormously and very positively to the overall positive result for the month. What we can also see is here that our payoff ratio was 1.04 to 1. What does it mean? What I do is I calculate the ratio between the average gain and the average loss in this case, and the average gain to the average loss is usually, and this is the average target performance, we are looking usually for 1.4 to 1. So this is definitely underperforming while the hit rate is overperforming. So usually the average target performance can be found at 47. So this said, with those numbers, you can calculate that the overall result for the month of August is definitely positive. We won't do it here right now, but you can calculate it yourself with a formula around the expected value. Nevertheless, we have to say that this is, for example, a first sign that really volatility is quite low currently. It's definitely the case, because the market, once it moves in our direction, is not moving as strongly as we usually target for, or what we are used to, what we should expect to see, that the EURJPY pushes in our direction. This is something which can be found here, even though thanks to the high hit rate, the overall result still was very positive for the month. So now, something interesting, I mentioned it already between the lines. Let's look at the fact that we are currently trading the short side. Some of you might say, okay, well, we are trading the short side in an environment which is obviously long. Is it a good idea? Yes, because it's the system telling us to do so and has a positive expected value. Yes, sure. So we definitely go for it. Nevertheless, we can formulate a problem based on that. The problem is not only that we are in a long environment, but also something I pointed out here already. The short side is currently underperforming, and this is not only the case for the month of August, but it's the case for the last 2.5 to 3 months. We can see that we, within this time span, only had a hit rate of 38.5%. Usually we have one in around 50%. So this is definitely something to worry about when we are now not only trading in a long environment, but also looking at the fact that the short side or short trades here are underperforming. On the other hand, we have to say, we have a good chance to get to see probably a mean reversion, because we are currently performing not as good as we should expect to perform, because we are trading below our target performance. By the way, the hit rate here of 47% can be split to the long and short side. You can see that we have 47 to 48% hit rate also, or then for the long and for the short side. And if we add it up and divide it by 2, we get out at 47%. So we can also say that here with the short side, we are currently, from a hit rate perspective, trading below our target performance. But the thing is, if you're performing in such a way we currently do, and below this what we should expect, the great thing is that rather sooner or later, and this is something that we expect to continue, this trend that this approach stays profitable, that we get to see something like a mean reversion. So chances are probably currently slightly higher that we'll get to see a winning trade on the short side. This is the positive aspect on this. And this is this, to sum all this up, it's purely theoretical. It's just some lines around the setup. What I can say is we have the trade, and now we just hope that the market will break lower and hopefully reach our target. And that's all we can hope for. It's only one trade within a series of trades. The overall expected value of this approach is positive, and let's just hope that today is one of these days where we get to see a positive result. And if not, well, we have a clearly predefined level where we get stopped out. If the market makes new highs, we definitely don't want to be short anymore. Getting stopped out, that's it. There's a question from Oscar, by the way, I'm just reading it. The question is, isn't it bouncing in a support? So you mean, okay, I think I see what you mean. So you're looking at this high here, right? And you're seeing that the market is currently finding support in this region. And in fact, the question is it not something I take into account when taking such a position? This is, in fact, a very interesting question, and coming up over and over again, in fact, and something many wonder about, especially about what I have to say about this. Well, I completely ignore it. To me, it doesn't matter if there's a support or a resistance. So in first place, it's that I know that this approach I just formulated is a profitable one. And if you have such an idea, what you can do is run a backtest. So you have those parameters statistically proven, and then you run the backtest and you find out, okay, it worked in the past here. The interesting thing about this now is that if it has shown over the backtest you run, it has been a profitable approach, that you do not need to adapt it, or that you don't need to look at such things like support, resistance here, or care about this. Nevertheless, and this is the interesting thing, if you know that this, we call it a basic strategy, is profitable and works, what you can surely do is, thanks to your overall market understanding, knowledge about the markets, you can start to try to optimize the expected value of this strategy. So if you know that the expected value is positive for the trading approach, then what you do, and now let's do this. I mean, it's only a few seconds, so probably we'll just add it here at the bottom. So the formula around the expected value is this. It's the average gain multiplied with the hit rate, and then you subtract the average loss multiplied with the loss rate. So, and what you know is that this formula is already positive. So let's short things up here. It's EV. We multiply 47%. This is the hit rate of this approach. The average, the payoff ratio is 1.4. And if you then subtract 0.53 multiplied with 1, what you get is 47 multiplied 1.4, 66, and then you subtract, so you subtract 5.3, and so what you get is 0.13, which is bigger zero, obviously. It means nothing more than you're making on average 13 cents per every euro, USD, JPY, whatever you risk. Okay, so now the target is not only to have a positive expected value, but by considering, for example, as resistance line, support lines, taking into account Fibonacci's, pivots, whatever you prefer, that you could try to optimize the overall expected value, trying to make, let's say, not only 13 cents, but 15 cents, let's say. But you have to make sure that it's not only once, but you do it over and over and over again. But all in all, to sum it up and to answer the question, I'm not looking at support or resistance lines here. And that might surprise many because they will just say, okay, does it make sense? Usually everyone is talking about this. It makes sense, yes. Nevertheless, what I first focus on is trading an approach with a positive expected value. And then I can start to optimize this expectancy by looking at levels like resistance, support, and all this. But first of all, it's necessary to trade the profitable approach. I just hope that this answers the question. And yeah, so that's it from my end so far.
So thank you for today. Tomorrow is another day. We have 5 days a week, 5 different traders. Our goal is quick and smart. So if you'd like to see more of us tomorrow live, or if you visit our YouTube channel, youtube.com/AdmiralMarketsFX, couple of hours later, all our webinars will be available there as a recorded video. Thanks to Jens. Greetings to all the time. Best trades, and see you hopefully tomorrow again. Bye-bye.